Hello everyone and welcome back to the channel. If you're interested in global economic fluctuations, smart money flows, and the impact of war on the USD, then today's video is definitely something you shouldn't miss. Will the USD weaken due to debt pressure and inflation as the US continuously spends billions of dollars on war? Or will it strengthen as the world rushes to find safe havens? In this video, we'll analyze this in an easy to understand, logical, and realistic way to find the answer. Before we begin, if you enjoy content about finance, economics, geopolitics, and global money flow trends, don't forget to like, subscribe to the channel, and turn on notifications so you don't miss the latest videos. Your support is the motivation for the channel to continue bringing you more quality and engaging content every day. And now, let's get straight to the point. Will the US spending money on wars weaken the USD? The more money the US spends on war, will the US dollar collapse or, conversely, become stronger? This is a question that is of particular interest to investors, economic experts, and the financial world. Whenever conflict erupts, billions of dollars are spent daily on weapons, logistics, military support, and aid to allies, leading many to believe that the US dollar will be under pressure to weaken due to the ever-growing budget and public debt. However, the reality of the market is not so simple. In many phases of war, the US dollar not only doesn't fall but actually rises sharply, becoming a safe haven for global capital as investors fear risk. This creates a fascinating paradox. The more war escalates, the more sought after the dollar sometimes becomes. So what is the truth behind the relationship between war and the strength of the USD? Will massive US military spending weaken the currency in the long term? Or will market fear continue to push the USD higher? Let's delve deeper into the analysis to understand the story behind the fluctuations of the world's most powerful currency. Amidst escalating global geopolitical tensions, the United States faces unprecedented pressure to spend heavily on military. Whenever a major war or conflict erupts, the US defense budget surges to meet the demands for weapons, logistics, troop deployment, aid to allies, and to maintain its status as a global superpower. The tens, even hundreds of billions of dollars poured into defense have led investors and financial analysts to ask a crucial question: will the US's continuous spending on war strengthen or weaken the dollar? At first glance, many would assume that when a nation spends so much on warfare, its currency will inevitably weaken due to increased budget deficits, ballooning public debt, and the risk of escalating inflation. This is a perfectly valid argument, because excessive public spending often forces governments to borrow more through bond issuance or even inject more liquidity into the economy, thereby weakening the currency in the long term. However, with the USD, the story is not as simple as what we usually see with other currencies. In fact, during many periods of war or international crisis, the USD not only did not weaken but also appreciated sharply. The reason lies in the fact that the USD has long been considered a global reserve currency and a leading safe haven whenever the market is unstable. When war breaks out, fear grips investors, causing money to quickly withdraw from risky assets such as stocks, cryptocurrencies, or emerging market currencies and flow into the USD and US government bonds. This creates a remarkable paradox. The more the war escalates, the greater the pressure on US spending. But the global demand for holding USD may also increase sharply. Therefore, the question of whether the USD will rise or fall as the US spends on war is always a hotly debated topic in financial markets. On the one hand, massive military spending could lead to a deeper US budget deficit, increasing public debt and putting pressure on the dollar in the long term. On the other hand, in the short term, global market fear often makes the USD the safest haven for capital. This is the key point that makes this topic particularly attractive and draws the attention of not only investors but also those who follow economics and geopolitics. Many people question whether, if the war continues, the US will be able to maintain the strength of the USD as the financial burden grows ever heavier. Or, conversely, will America's central role in the global financial system help its currency maintain its position despite any fluctuations? To answer that question, we need to look deeper into how markets react to war, how international capital flows, and the unique role of the USD in the world economy. This is not just a story about a currency, but also a story about the market's confidence in America's economic, military, and financial strength in these turbulent times. When analyzing why the US dollar might weaken amidst continued US spending on war, one must first consider the enormous financial pressure a prolonged conflict places on the national budget. War not only costs money for weapons, logistics, troop deployment, and allied aid, but also entails a host of other expenses such as equipment maintenance, personnel support, and post-conflict reconstruction. These expenses can amount to tens, even hundreds of billions of dollars, forcing the US government to seek additional funding. The most common method is issuing more treasury bonds to borrow from global financial markets, while simultaneously increasing the size of the federal debt. As public debt increases rapidly, investor confidence in the long-term fiscal health of the US can be affected, thereby putting pressure on the dollar to weaken. In some cases, to support the economy or ensure liquidity for the financial system during wartime. The amount of money in circulation may also be increased through loose monetary policies. When too much money is created, the value of each USD risks erosion because the money supply increases faster than the real growth rate of the economy. In addition, war is often a strong catalyst for escalating inflation. Whenever conflict breaks out, especially in regions that are crucial to energy or global supply chains, the prices of oil, gas, gold, and many basic commodities tend to rise sharply. This quickly drives up transportation, production, and energy costs in the US, causing domestic prices of goods and services to increase. When inflation rises, the real purchasing power of the USD decreases, meaning that with the same amount of money, people and businesses can buy fewer goods than before. This is one of the factors that directly diminishes the real value of the dollar in the eyes of the market and consumers. Furthermore, budget deficits are also a very important factor. When war spending far exceeds tax and other revenues, the federal budget falls into a deeper deficit. The larger the gap between revenue and expenditure, the higher the pressure to borrow, leading to the burden of interest rates and future debt repayment obligations. Investors are often very sensitive to signs of prolonged fiscal imbalances, as they fear that in the long term, the financial strength of the United States may be affected. This concern can reduce confidence in the USD, especially in the long term, making it vulnerable to weakening if the war continues and costs continue to escalate. One of the most surprising aspects for many when analyzing the impact of war on the US dollar is the fact that in many cases, war does not immediately weaken the USD, on the contrary, it significantly strengthens it. This seemingly paradoxical situation is a pattern that has repeated itself many times in the history of global finance. The first and most important reason lies in the role of the USD as a safe haven asset. Whenever geopolitical crises erupt, fear quickly spreads across global markets. Investors begin selling off stocks, withdrawing capital from emerging markets, cryptocurrencies, speculative commodities, and other risky assets to protect their capital. In times of instability, what investors care about most is no longer high returns, but safety and the ability to preserve the value of their assets. It is at this time that the US dollar, along with US government bonds, often becomes the top destination for global capital flows. The USD holds such a special position because the United States has long been considered the world's largest economy with a financial system of superior depth and liquidity. When markets are turbulent, global investors need a place large enough to absorb massive capital flows while ensuring quick transactions. And there are few better options than the USD. Therefore, whenever war breaks out, the demand for holding dollars tends to surge. This is a paradox that many people don't anticipate. The larger the war, the more widespread the fear, and the more global capital flows into the USD. It can be said that, in the short term, the power of fear sometimes outweighs the pressure of military spending that the US has to bear. Besides its safe haven role, the second reason the USD can strengthen is the central position of the US in the global financial system. The vast majority of international trade transactions today are still conducted in USD. From the buying and selling of oil, gold, and precious metals to other essential commodities, many countries, businesses, and financial institutions worldwide need USD for payments, investments, or reserves. Therefore, even during wartime, the demand for USD in international trade remains very high. In particular, the energy market is an extremely important factor. Oil, the commodity most sensitive to war, is typically priced in USD. When conflict breaks out, oil prices tend to rise sharply. leading to a corresponding increase in the demand for USD for payments. This inadvertently provides further impetus for the dollar in the foreign exchange market. Furthermore, gold and many other strategic commodities are also primarily priced in USD, further reinforcing the role of this currency during periods of instability. Another factor that cannot be ignored is the foreign exchange reserves of central banks around the world. Many countries hold large amounts of US dollars and US Treasury bonds as strategic reserve assets. When war or crisis occurs, central banks tend to increase their USD reserves to protect their national financial systems from exchange rate fluctuations and capital flows. This continues to create sustained demand for the dollar. Overall, the strength of the USD during wartime stems not only from the US economy, but also from the world's belief in the central role of this currency. Therefore, in the short term, even with massive US spending on war, the USD can still appreciate significantly due to its safe haven role and consistently high global demand. This is a key point that helps your video create surprise and keep viewers engaged until the end, because it contradicts the common belief that war means a weakening currency. From a historical perspective, the relationship between war and the strength of the US dollar is always two-sided. And this is what makes your video more persuasive. Looking back at the 2003 Iraq War, before the official outbreak, global financial markets were in a state of heightened anxiety, causing capital to flow towards safe haven assets, with the US dollar being a top choice. In the short term, the dollar often benefited from investor safe haven sentiment, especially when war led to significant volatility in oil prices and stock markets. The OECD also noted that the impact of the Iraq War on financial markets mainly occurred in the first few days, after which market sentiment quickly stabilized. Similarly, after the 9/11 attacks and the Afghanistan War, the USD repeatedly demonstrated its role as a safe haven currency during times of crisis. When instability increases, investors often withdraw capital from emerging markets and shift to holding cash, US Treasury bonds, and the dollar. This is why, in the short term, war doesn't always weaken the USD. On the contrary, it can even push the currency up significantly. Historical data from the DXY index also shows that during periods of major military tension, the USD often surges considerably. This pattern has repeated itself in recent Middle Eastern conflicts. Whenever tensions escalate, oil prices rise sharply due to concerns about supply disruptions, leading to increased demand for USD payments since oil is primarily priced in dollars. This inadvertently provides additional impetus for the USD in the short term. Therefore, many investors often observe the dollar's reaction immediately after major military events as an indicator of market fear. A very clear and recent example is the Russia-Ukraine war. When the conflict erupted in 2022, many currencies around the world, especially European currencies, weakened significantly against the USD. Studies show that the Russia-Ukraine war caused many currencies to depreciate against the US dollar, while the USD became a safe haven for global capital flows. This further reinforces the argument that, in the short term, wars often strengthen the USD due to market defensive sentiment. However, looking at the long term, the story is quite different. Prolonged wars like those in Afghanistan or Iraq have left an enormous financial burden on the United States. Trillions of dollars in military spending, plus reconstruction costs, veteran care, and interest payments on public debt, have placed immense pressure on the federal budget. This is the real threat to the USD in the long term. As public debt rises and inflation is driven by soaring energy and commodity prices, the dollar risks eroding in value over time. From a historical perspective, a very strong conclusion can be drawn for your video. In the short term, wars often cause the USD to appreciate due to safe haven flows. In the long term, the costs of war and public debt pressures are the factors that make the USD more susceptible to weakening. Now, let's look at the future scenario, as this is the part that interests viewers the most. If the US continues to spend money on war in the coming period, which direction will the USD go? In reality, the movement of the USD will depend heavily on the duration and extent of the conflict. In the first scenario, if the war is short-lived, the market usually reacts very quickly with fear and defensive sentiment. Global investors tend to sell off stocks and risky assets and shift their funds to safer places like gold, US Treasury bonds, and especially the USD. This safe haven sentiment often causes the USD to surge in the early stages of conflict. The more instability there is, the greater the demand for holding dollars, as it remains the world's largest reserve currency and is considered a store of value during crises. Therefore, if the war is short-lived, lasting only a few weeks or months before subsiding, the USD is highly likely to benefit and continue to appreciate. However, in the second scenario, where the war lasts for months or years, the story begins to change. As military spending steadily increases, the US is forced to spend hundreds of billions of dollars more on defense, aid to allies, logistics, and reconstruction. This leads to rapidly increasing public debt, a growing budget deficit, and heavier financial pressure on the economy. Simultaneously, the prices of oil, energy, and basic commodities could continue to escalate, driving inflation higher. As inflation persists, the real purchasing power of the US dollar will gradually diminish over time. This is when the market begins to shift from short-term safe haven sentiment to concerns about the long-term financial health of the United States. The longer the war drags on, the more investors may begin to question whether the US can sustain this massive spending without impacting the strength of the dollar. As long-term confidence declines, the USD is likely to lose its upward momentum and even weaken over time. In other words, while war may boost the USD significantly in the short term, in the long term, the costs of war, public debt, and inflation are the factors that will cause the USD to gradually decline. This is the key future scenario that global investors are closely monitoring in the current geopolitical context.